Hey guys, this is your trusted advisor here. Today I will be going over how life insurance works in Canada. I know it's not the most exciting topic out there, but I promise it will be more relevant to you and your family's financial health than you think. So stay until the end of this video to find out why. I will be going over the basic terminology in the life insurance, the different types of life insurance you can get in Canada, how they really work, and how to choose the life insurance that best suits you. I will try to keep it short and simple. So let's get started. So, why do we need a life insurance? This might be the first question that's in your mind. I know that no one will wake up in the morning and say, "Oh yeah, I need to get one." But that doesn't mean you can ignore it. It plays a huge role on the risk management side. You can think of it as a gift for your loved ones in case you pass away sooner than you expect. It helps covering the cost of your funeral, any leftover debts or tax bills, or even save your parents, friends, or siblings from a financial burden. Basically, in a life insurance, you are making regular payments during your life, and in exchange, the life insurance company will guarantee a predetermined sum of money to your loved ones after your passing. And that's why it's formally called a death benefit. Now, before we get any further, let's go over some basic terminology that will come across in a life insurance. A policy is your agreement with the insurance company. This makes you a policy holder because you are the person that owns the life insurance. If you are well off though, you can also buy policies on behalf of your loved ones too. The payments you make regularly to the insurance company to maintain your policy and is called premium, and the premiums are generally paid monthly, quarterly, semi-annually, or annually. Lastly, the person who will receive your death benefit is called the beneficiary. It doesn't have to be one person. You can choose to divide up the payouts among several beneficiaries. Oh, actually, it doesn't even have to be a person for that matter. It can be a charity, a company, or even a trusted fund for their cats and dogs. Yep, that's right. In 2010, a person in Miami left her Chihuahua named Cointenta an estimated worth of $11.3 million. And in 2011, an Italian woman left a stray cat a sum of $13 million. In case you are an accountant and you are thinking about taxes all the time in Canada, your beneficiary does not have to report life insurance payout as taxable income. When we talk about the different types of life insurance, it comes down to two major: term and permanent. Term life insurance, as the term suggests, no pun intended, covers you for a specific period of time, usually ranging from 10 to 30 years. Say, for example, when you get a policy with a 20-year term, the insurance company will pay your beneficiaries if you die within the next 20 years. With most policies, your premium won't increase during that time. Now, you might be wondering how much it costs for a term life insurance. The cost of a life insurance largely depends on your health conditions and age. But if you're young and healthy, a $100,000 life insurance policy is only about the price of a large pizza each month. If you sign up later in life, though, your premium will be much more costly because you're at a higher risk. That is why, if you can't afford it, I would suggest you to sign up as early in life as you feel a life insurance is necessary. Term insurance is a great option if you feel you only need coverage for a set period of time, say until your home mortgage is paid off or until your kids move out. Many term policies can be converted to permanent ones later in life, and there's no need to take another medical exam to renew your policy. Insurance providers have to renew the policy no matter what. So, what happens if I still need insurance coverage when my term insurance expires? This brings us to our next type of life insurance: permanent life insurance. It provides lifelong coverage instead of only a specific period of time. Premiums are typically locked in, but most of the time a lot higher in the beginning, maybe at the cost of 10 large pieces each month instead of one. In a term life insurance, if you still live beyond the terms that you are covered for, then obviously your beneficiary won't get paid, where in a permanent one, your beneficiary is bound to have a payout, unless of course you are a vampire. Permanent life insurance is mainly in two forms in Canada: whole life insurance or universal life insurance. For whole life insurance, your premium pays your insurance coverage plus an investment portfolio that can grow your money over time. The insurance company manages that portfolio for you, aiming for low risk and moderate growth. And in case you are wondering again, yes, These investments are also sheltered from taxation. Whole life insurance can be either participating or non-participating. In a participating policy, you will share the company's profit in the form of dividends, which you can use for extra cash flow, reducing your premiums, or boosting your death benefits. The key advantage is once they give out those dividends, the insurance company cannot collect it back. So unlike the stock market, the cash value inside the whole life insurance policy cannot go down. Now, here's an important point to understand. When you pass away, your beneficiaries will receive the full, guaranteed death benefit, but the accumulated cash value does not get paid out separately. The cash value stays with the insurance company. That's how current policies work in both Canada and the USA. On the other hand, the universal life insurance gives you the highest degree of freedom. It acts more like the investment accounts with a life insurance component. Instead of paying regular premiums, you can invest as much as a yacht or as little as a cup of coffee. Another difference is that instead of being locked in, you have the ability to increase or decrease your premiums as you wish according to your budget. Why? Mainly utilize the tax shelter room inside the policy. As you can see, because of the high degree of flexibility and freedom, many wealthy Canadians often use this type of policy to invest once they max out their tax-free saving or RRSPs. I know that was a lot of information on the different types of life insurance. You might be wondering, how do I know how much coverage is enough for me or which product to choose from first? It is always the coverage amount. Usually, I would suggest get a coverage worth 7 to 10 times your annual salary. If Tom is making $100,000, for instance, then $1 million life insurance coverage is an ideal amount. Then depending on the budget and the features that you want, a whole life insurance, a term insurance, or even a hybrid. One little bit of both sides may be a good suggestion. Usually, I suggest all of your insurance, premium combined, should be no more than 10% of your income, using 10% of your assets to cover the remaining 90%. If any of this sounds confusing to you, leave a comment down below or contact me directly for a free meeting. To understand your situation and help your family achieve financial security, visit our website emeraldwealthservices.com. If you want to know how money works and how you can work with money, then I will see you next week. Bye, guys.